You thought you were doing your children a favor by putting their name on the deed to your house, but you just handed them a $75,000 tax bill. This single innocent mistake is quietly destroying family wealth across the country right now, and unless you fix it, the Internal Revenue Service is going to take a massive cut of the home you worked your entire life to pay off. But there is a legal loophole that completely wipes out this tax, and I'm going to show you exactly how to use it. Every day, I see hardworking parents try to simplify their estate by gifting their house to their kids before they pass away. I've spent years helping families navigate the incredibly confusing world of estate planning, and I can tell you with absolute certainty that what feels like a smart shortcut usually ends up being a catastrophic financial disaster. In this video, we are going to break down exactly how this $75,000 tax trap works. We will look at the exact math so you can see it with your own eyes. We will explore the hidden risks of nursing homes and family lawsuits that you probably have not considered. And finally, I will reveal the specific legal tools you must use instead to guarantee your children get your home completely tax-free. Let us start with the most common scenario. You are getting older, you want to make things as easy as possible for your family, and you want to avoid the dreaded probate court. So you go down to the county clerk's office or you hire a quick online service and you file a quitclaim deed. You add your son or daughter to the title of your home. You think you have just secured their future. You think you have outsmarted the system. But what you have actually done is triggered a tax nightmare through a mechanism called carryover basis. To understand why this is so devastating, we have to talk about how the government calculates capital gains taxes. When you buy a piece of property, the price you pay for it is known as your cost basis. Let us imagine you bought your home back in 1985 for $50,000. Over the decades, you paid the mortgage, fixed the roof, remodeled the kitchen, and watched your neighborhood grow. Today, that same house is worth $450,000. That is a wonderful return on your investment, but it also means there is $400,000 of built-up equity or profit sitting in that house. If you were to sell that house today, you would have to deal with capital gains taxes on that $400,000 of profit. However, the tax code has a special exemption for primary residences, meaning most people do not pay taxes when they sell their own home. But here is where the trap snaps shut on your children. When you gift your house to your child while you are still alive, by simply adding their name to the deed or transferring it to them outright, the IRS looks at that transaction and applies the rule of carryover basis. This means your original cost basis of $50,000 carries over to your child. They do not get credit for the current value of the home. They are legally adopting your 1985 purchase price. Fast forward a few years, you pass away, and your child decides to sell the house because they already have a home of their own, or they need the money to send their own kids to college. They sell the house for its current market value of $450,000. But remember, their legal cost basis is only $50,000. The IRS sees a massive $400,000 profit. And because it was not your child's primary residence for 2 of the last 5 years, they do not get the primary residence tax exemption. They have to pay long-term capital gains tax on that entire $400,000 amount. Between federal capital gains taxes, which are often 15 or 20%, and state capital gains taxes, which can add another 5 to 10% depending on where you live, your child is easily looking at a blended tax rate of 20% or more. 20% of $400,000 is $80,000. Even with a few deductions for closing costs, your child is writing a check to the government for roughly $75,000. That is $75,000 of your family's hard-earned wealth wiped out in a single stroke of a pen, all because you tried to do the right thing by putting them on the deed while you were alive. Did you know that over 60% of Americans do not have any sort of estate plan in place, leaving their largest assets entirely vulnerable to this exact mistake? It is a staggering statistic, and it shows just how desperately we need to change the way we think about generational wealth. Now, let us contrast that nightmare scenario with what happens if you do things the right way. If you leave the home to your child when you pass away rather than gifting it to them while you are alive, the tax code treats the property entirely differently. Through a provision known as a step-up in basis, your child's cost basis is automatically stepped up to the fair market value of the property on the exact date of your death. Let us run the same numbers. You bought the house for $50,000. It is worth $450,000 when you pass away. Because you held the property until your death, your child inherits the home with a new cost basis of $450,000. If they sell the house the very next week for $450,000, what is their profit in the eyes of the IRS? Zero. $450,000 minus $450,000 is zero. There is no capital gain. There is no $75,000 tax bill. They get to keep every single penny of the sale. This one single concept, the step up in basis, is arguably the most powerful wealth preservation tool available to the middle class, and you completely forfeit it the moment you sign a quitclaim deed during your lifetime. But the tax bill is only the first layer of this disaster. Let us talk about the incredible risks you expose yourself to when you add someone else's name to your property title. When you put your child on your deed, you are legally giving them an ownership stake in your house. It is no longer just your asset, it is their asset too. And because it is their asset, it is completely exposed to their liabilities. Imagine your daughter is a fantastic, responsible person, so you put her on the deed to your house. A few years later, she gets married, but unfortunately the marriage falls apart and ends in a bitter divorce. During the divorce proceedings, her soon-to-be ex-husband's aggressive attorney starts hunting for assets. Because your daughter's name is on the deed to your house, a portion of your home may now be considered part of her marital assets, or at the very least, an asset that can be leveraged in the settlement. You could find yourself dragged into your child's divorce court, fighting to keep your own home. Or consider an even more common scenario. Your son is driving home from work, the roads are slick, and he causes a severe car accident. The injuries are extensive, and the other driver sues him for an amount that far exceeds his auto insurance limits. The victim wins a massive judgment against your son. Because your son is a legal owner of your house, that judgment creditor can place a lien on your property. They could potentially force the sale of the home to satisfy your son's debt, leaving you out on the street. Or what if your child faces unexpected medical bills, loses their business, and has to declare bankruptcy? The bankruptcy trustee will look at all of their assets, including their ownership share in your house, to pay off their creditors. When you give away a piece of your home while you are alive, you are attaching your most valuable asset to every single mistake, accident, or misfortune that might happen in your child's life. It is an incredibly dangerous gamble, and the stakes are simply too high. You might be thinking that a simple will is enough to fix all of this, but later in this video, I'm going to explain why relying on a standard will could actually trap your children in probate court for years, bleeding them dry in legal fees. The absolute best way to pass down your home involves a completely different type of document, and we will get to that shortly. First, we need to address another massive issue that wipes out family homes: the nursing home threat. As we age, the reality is that many of us will eventually require long-term care, whether that is in-home nursing or a residential facility. The cost of this care is astronomical, easily exceeding $8,000 to $10,000 a month in many parts of the country. Very few families can afford to pay this out of pocket for long, which means many people eventually have to turn to Medicaid to help cover the costs. Medicaid is a government program designed for individuals with limited assets. To qualify, you basically have to spend down your life savings. Now, generally speaking, your primary residence is exempt when Medicaid calculates your eligibility. They will not force you to sell your house to qualify for care. But here is the devastating catch. the Medicaid Estate Recovery Program. Federal law requires states to attempt to recover the money they spent on your care after you pass away. If your house goes through probate court, the state will place a claim against your estate, force the sale of your home, and take the proceeds to reimburse themselves for the nursing home bills. Your children get nothing. So people panic. They hear about Medicaid recovery and they think, I will just give the house to my kids right now. If I do not own it, Medicaid cannot take it. Right? Wrong. Medicaid has a strict 5-year look-back period. If you apply for Medicaid, they look at every financial transaction you have made over the last 60 months. If they see that you gifted a house worth $450,000 to your children, they will penalize you. They will take the value of that house, divide it by the average monthly cost of care, and disqualify you from receiving any Medicaid benefits for that number of months. In the case of a $450,000 home, you could be disqualified from receiving help for 4 or 5 years. You will have no way to pay for the nursing home, and your children will be forced to try and come up with the money to care for you. Gifting the house does not protect it, it traps you. Furthermore, let us consider the emotional toll and the family dynamics involved when you leave property directly to multiple children without a clear legal framework. Many parents simply say, I will leave the house to my 3 kids equally. They think this is fair. But fairness in theory often leads to absolute chaos in practice. Imagine you leave the family home to your 3 children. Child A lives nearby, has a growing family, and wants to move into the house. Child B lives across the country, has no emotional attachment to the property, and just wants to sell it to get their share of the cash. Child C thinks the housing market is going up and wants to keep it as a rental property to generate passive income. Who wins? You now have 3 co-owners with completely conflicting interests. Child A cannot afford to buy out Child B and Child C. Child C does not want to sell, but Child B is demanding their money. Because they are all equal owners, none of them can force the others to do what they want without going to court. This leads to a lawsuit called a partition action, where one sibling literally sues the other siblings to force a judge to order the sale of the property. The family is torn apart, holidays are ruined forever, and a massive chunk of the home's value goes to the lawyers fighting the case. Leaving property outright to multiple kids without a structured plan is like tossing a grenade into your family tree and hoping it does not explode. Have you ever wondered why the wealthy seem to seamlessly pass down massive estates generation after generation without paying these outrageous taxes or ending up in court? The secret is not that they have smarter children. The secret is that they use specific legal structures that completely bypass these traps. So how do we solve all of these problems? How do we ensure your children get the step up in basis to avoid the $75,000 capital gains tax while also protecting the house from their creditors, protecting it from Medicaid recovery, and preventing sibling lawsuits? The answer lies in proper strategic estate planning, and there are 3 primary tools you need to understand. The first tool is the easiest and most cost-effective, though it is not available everywhere. It is called a transfer on death deed or a beneficiary deed. Currently, over 30 states allow this. A transfer on death deed works exactly like a beneficiary designation on a life insurance policy or a retirement account. You file a simple document with the county stating that upon your death, the property automatically transfers to the person or people you name. While you are alive, you maintain total control. You can sell the house, you can refinance it, you can take out a reverse mortgage, or you can change your mind and revoke the deed entirely. Your children have absolutely no ownership interest while you are breathing, which means their divorces, bankruptcies, or car accidents cannot touch your house. And because the transfer happens at the exact moment of your death, they get the full, massive step up in basis. If they sell the house the next day, there is 0 capital gains tax. Even better, in most states, a transfer on death deed bypasses probate court entirely, saving your family thousands of dollars in legal fees and months of agonizing delays. However, the transfer on death deed is not a perfect silver bullet. It does not solve the Medicaid estate recovery problem in all states, and it does not solve the sibling rivalry problem if you are leaving it to multiple kids with different ideas about what to do with the property. It is a fantastic tool for simple situations, perhaps an only child. But for true protection, we have to look deeper. This brings us to the second and arguably most essential tool for the modern family, the revocable living trust. If you own real estate, you almost certainly need a revocable living trust. When you set up a trust, you legally transfer the ownership of your house from your name as an individual into the name of the trust. But because you are the trustee, you retain 100% control over everything. You can sell the house, change the beneficiaries, or completely dissolve the trust whenever you want. Your daily life does not change at all. But when you pass away, the magic of the trust activates. First and foremost, assets held in a trust completely avoid probate court. Your family does not have to hire an attorney, they do not have to wait for a judge's permission to do anything, and your financial affairs remain totally private. Secondly, just like the transfer on death deed, the trust guarantees your children receive the step-up in basis, wiping out the capital gains tax threat. But where the trust truly shines is in how it controls the distribution of the asset, solving the family feud problem. You can write specific rules into the trust. For example, you can stipulate that if one child wants to buy the house, they have the first right of refusal at a fair market appraisal. And the trust can dictate exactly how they pay off their siblings over time. Or you can mandate that the trustee must sell the house and distribute the cash equally, preventing any arguing. You can even add protective clauses that say if your child is going through a divorce or a bankruptcy at the time of your death, their inheritance remains safely locked inside the trust, protected from their creditors until the danger has passed. The revocable living trust gives you control from beyond the grave, ensuring your wealth becomes a blessing, not a curse. But remember the one flaw of the revocable trust? Because you still have access to the asset, the government still considers it yours for Medicaid purposes. If you go into a nursing home, a revocable trust will not protect your house from Medicaid estate recovery. To solve that final ultimate problem, we have to use the absolute most powerful tool in the estate planning arsenal, the Irrevocable Medicaid Asset Protection Trust. This is an advanced strategy and it requires you to give up some control, but the protection it offers is absolute. When you place your home into this specific type of irrevocable trust, you are legally removing it from your taxable estate and your Medicaid eligible estate. You name someone else, usually a trusted adult child, as the trustee. You retain the right to live in the house for the rest of your life, but you no longer own it. Because you do not own it, it is completely invisible to Medicaid. If you need nursing home care, the house is not counted against you, and when you die, the state cannot place a lien on it to recover their costs. The house is completely shielded. And because of the specific way these trusts are drafted by specialized elder law attorneys, your children still receive the step-up in basis when you pass away. They get the house, totally protected from nursing home costs, totally protected from probate, and totally tax-free. You just have to make sure you set this trust up at least 5 years before you actually need a nursing home to avoid the Medicaid look-back penalty. Let us briefly recap the crucial lessons we have covered today to make sure you do not make a devastating mistake with your family's future. First, never simply gift your home to your children while you are alive, as doing so transfers your original cost basis to them and guarantees a massive capital gains tax bill when they sell. Second, remember that adding someone to your deed exposes your life savings to their divorces, lawsuits, and bankruptcies. Third, beware the nursing home trap. Giving away assets triggers penalties, but failing to plan allows the state to seize your home after you pass away. And finally, utilize the right tools like a transfer on death deed, a revocable living trust, or an irrevocable asset protection trust to ensure your family gets the step up in basis and avoids the nightmare of probate court. I want to know how this issue has impacted you. Have you or your parents ever dealt with the nightmare of probate court or had a surprise tax bill from an inherited property? Please comment your experience down below so we can all learn from each other's situations. And I will be down in the comments answering as many questions as I can.